These are the guys that I just closed a deal with in December. As I mentioned before, I work with several Microsoft retirees and help them invest their money. And we bought a new building in the Bel-Red corridor. I was amazed at how low the rates have gotten. And Vin Rielly here with Symetra did the permanent money on it, the life insurance company, and Lee Graeve's company, actually Matt Couch, but with Intervest, they did the brokerage and shopped the loan to several people. And Jim Cooch is my banker with Wells Fargo Private Banking. What we wanted to do is kind of bring people up in current with real estate investing and real estate financing. And as you all know, it got real heated in 2006 and 7, and then totally crashed in 2008, and there were pretty much no loans to be had for a couple of years, and then it's starting to come back. So what we're going to do is kind of understand where the lending industry is right now, and it will help brokers like you to guide your tenants into investments and acquisitions and kind of knowing what they can finance and what they can't.
Around the middle of maybe the beginning of last year, we started to see loans come across our desk that were, the regularity with which we saw new acquisitions really started to increase. That kind of continued throughout the year. We see a wide variety, as you might imagine, closing that many loans of acquisitions, midterm refinances, refinancing of loans that have reaching their maturity date. We try very hard not to put a box around the types of loans we will do and we won't do. The idea being there for us, as we see it, is that will lead to missed opportunity. I think it's important to start early if you're working with borrowers that have loans coming up on maturity dates. The rate environment today, there are some low 4s, even sub 4% rates available for longer term money. At the end of the day, though, if you're able to borrow long term, I think sub 5%, you are in a good place. We'll be fairly steady. You're going to see that 10-year Treasury, I think, drift between a 180 and maybe a 220, 225 range for maybe the next 12 months, 18 months. I think when it does start to move up, it will move quickly, and so it will behoove borrowers to be ready to move when it does.
Yield maintenance is really simply, it depends upon where your interest rates are today versus what your note rate is. So if interest rates are lower today, of course, the lender still wants his yield for the term of the loan. So I guess in my simple way of thinking, if rates are higher than your note rate, they can get their money back and reinvest it at a higher rate. So when you do your yield maintenance calculation, it's going to be less, and they usually say a minimum of 1%. So they just want their yield, Fred. That's what they agreed to in the contract. So,
what it seems to me, it's a number of months or years until your loan matures, and if they got back that $3 million, and what would they have to invest it at to in today's rates, and you make up the difference of their lost opportunity, because I wouldn't be in a hurry to refinance it if my loan rate was lower than what current market is. But I got a 5.75% loan that I thought was just a great deal 3 or 4 years ago, which it is, and then lo and behold, you could probably get 3.75 on the same product, but you can't get it till your loan matures. So that's part of the problem with it.
I would say from the experience as I watch with our bank, that clearly a huge differential between the commercial markets and the residential markets. I think on the commercial side, I do think the commercial banks recognize we want to be a lender that is repaid, and we want to work with good developers, borrowers, clients who really understand the industry and know how to manage and own their property. So I do think the banks have worked very hard to find avenues to not push a property or a loan into a foreclosure mode or restructure where we end up in terms of owning the properties. I think the combination of a good region, but also I think the banks clearly have worked hard to modify, adapt, and try to work with the borrowers to give them time to work through the issues of the property.
I have a client that probably made the ultimate mistake, is that he put a Wall Street conduit loan on his 70,000 square foot industrial building that he had leased to an electrical contractor that sold to the housing industry. Put a 10-year loan on it. The lease was 10 years. The lease came due. The loan came due. So what do? The lender kicked the can down the road a year. So that's partly what's happening here. But it's interesting to look at the rent roll. They put a conduit loan on 10 years ago, and you look at the rent roll, and the leases are triple net relative to when they put them in place 10 years ago. The new leases now are gross rents. So you start looking at the transaction and wonder how you're going to underwrite this, how it's going to be appraised, and how the current borrower is ever going to get out of this loan. And it'll probably be kicked down the road again. I think that's a lot of what's going on.
I tend to agree with Lee, where we had a lot of lenders, lending institutions, the CMBS market, extend loans with the hopes that the economy would turn around. I think largely they've been rewarded for doing that, in that we have seen nationally the markets stabilize, new leases getting done, in some markets lease rates increasing. So now you may be at a position where your property has positive coverage, or 1-2-0 debt service coverage. Might not still qualify for new financing today, but you're a lot closer than you were before. I think that's largely why we've seen it. The other thing I would suggest is you're starting to see capital chase real estate again.
Lenders are back. Lenders have lots of money. They want to get it out the door, but they're not going to be aggressive. I think everybody learned from the CMBS Wall Street fiasco that being aggressive is not the right thing to do.
The request or inquiries for credit has continued to stay very strong. There has not been any particular either product type or one group of borrowers in doing that. Within, obviously, us being a commercial bank and other commercial banks that you would work with, our side in terms of really the steps that you mentioned in terms of with the foreign investor or borrower. So we start with the borrower, the individuals. We look at the relationship, and the credit or the property is the third piece. So we've got some real screens and filters that we have to go through before we can even get down to the real estate side. Having said that, again, we continue to be fortunate that the lights are on, the doors are open, and again, money rates are certainly in attractive range.
I'd like to thank our panel so much. Appreciate it.